Well, hello, everybody. That recording in progress button. How is everybody doing? Jeff, how are you?
Good morning, Roger. I'm excellent. How are you?
Doing great. Doing great. I think Lance is going to be coming in here as well. Folks, welcome to New Year's 2022. I want to make sure everybody can hear me okay. There's Lance. How are you, Lance?
Roger, I feel like I need a new shirt now.
Hey, it's a new year. It's a new me.
Hold on. Am I on camera? Do we have people here? All right, I'm going to go and change. I will be right back.
Go for it. Don't worry about it. Jeff and I will keep everybody busy. Let me just hit up some questions here. Let's see what the feedback is. Happy New Year, Mary. Hey, Carol. How are you? Last year, we did this pre-recorded, and we were getting so many questions that this year we decided to do it live, right? Why not? So, Jeff, how are you feeling this year?
I feel strong. I feel good. I feel like it's going to be a crazy year, which is right up my alley. It's going to be a lot of action. So, feels good.
I think
how are you doing?
I'm doing really well. You know, it's really interesting because I had my turning point 2022. It was a kind of like a prognosis of what to expect this year. Levels, excuse me. And it was really interesting because my prognosis was basically small caps higher, a lot of volatility, not a lot of gains in the market, but a lot of volatility. So really good for swing trading, and REITs and financials. So yesterday, that was pretty in a nutshell my thing. Wow, you're fast, Lance.
Always keep a few dress shirts in the closet behind me.
That's a professional right there. I'll tell you, man. That's like a 90-second. That's admirable right there. So getting back to the topic at hand, I gave a prognosis that REITs and apartment building REITs and residential REITs and energy stocks were going to do really well. And yesterday I read a report that Bank of America came out, and I'm not kidding. They literally said exactly the same thing. Higher volatility, no gains, just a lot of volatility, market not going anywhere. And they gave two stocks. One was Oxy, and one was Mid-America Apartment Building, which is a REIT. So I just thought it was kind of interesting. Yeah, you pulled a Superman with that wardrobe change, Lance.
Oh yeah.
So folks, this format is going to be really great because you guys can actually ask us questions. We can give you answers live. If one day Lance is not here, then Jeff will fill in. If I'm not here, then Lance can fill in. But I really like this format, and I want to get into. And it's really good to have an opinion from more than one person. So welcome, and please send us feedback. We'll post our email addresses here. Now, my email address, just so everybody knows, and folks, Lance, Jeff, why don't you go ahead and give out your email address? My email address, and I'll post it for everyone here in the chat. This is a very easy email to access me. So please do that. Jeff just posted his email. Lance will post his email. Please feel free to send us email. Good, bad, ugly. This is our direct email. It'll go directly to us. And hey, Joshua, how are you? And you guys will be able to get feedback directly from us. So let me start off with Jeff, and then I'll move on to Lance. Jeff, tell me, what are you seeing? What are some of the major moves? Let's start with the big picture view. What are some of your big moves that you're expecting for the next quarter? Let's just do a quarter at a time because it's going to be a long year.
It's going to be a really long year, and we kind of been hitting on this topic, you and I, in our weekly call, which is the granddaddy of this program, about how low-hanging fruit. Rates are going higher. My base case was going to be a shock move in rates higher. That's already started. Financials would catch a bid because they make money with higher rates. The inflation trade is here to stay. I think you see sick inflation, like painful inflation, in the world in 2022, which leads to all kinds of tail events, black swans, and that's already starting. What's kind of bizarre to me is we're having extreme moves in like almost every stock I look at, but but all the sectors are negating each other. So if you look at the market on the whole, the wife walks in, it's like, ho hum, boring day in the market. I'm like, you gotta be kidding me. Underneath the hood, every stock is moving like 3 to 5%. And so we spoke about this on our little Slack board yesterday with Lance and with Matt Warder and a few other guys internally, that on the surface, it doesn't look like there's a lot of volatility, but underneath the hood in individual stocks, there are massive moves. And so even though they negate each other, what I'm seeing is a state of heightened emotion. There's animal spirits in the markets, if you will, on both the buy side, like on both buying and selling. And so I think it's only a matter of time before that becomes the uniform atmosphere regime for the entire market. I think we're kind of like in no man's land, so to speak, just to start, where all these different fund managers are doing kind of what us three have been talking about, but they're trying to do it all at once. So it's kind of like negating each other from big market gyrations.
Yeah, and I kind of like how you described that. I also have, and again, this is just my 5 cents. I'm not the know-it-all expert, but my 5 cents is it has a lot to do with the fact that we still have a lot of retail traders kind of influencing the market. You have most of the institutional traders just literally coming into the market today, tomorrow. So I'm seeing similarly to what you're seeing. Kind of, you have that volatility, that struggle with individual stocks, but they seem to be moving, but they're not really going. They're not really. The movement is there, but it's not too directional at this point yet. But there is starting to become some movement. But it's not, as far as sector to sector, they're not jiving.
They're not value. There's a lean towards value over growth that I'm seeing, and I'm seeing it internationally. I'm looking at some beat down markets, some laggard markets. If you look at Europe, which has lagged the United States by hundreds of % over the course of the last 10 years, you're seeing a much stronger start, frankly, to France, to Germany, to some of these other countries than you are. And one of the reasons we've been such world beaters is because of our tech stocks. And a lot of our tech stocks are trading at nosebleed levels. They have premiums for their growth projections, but they don't have actual earnings. So you're seeing stocks with no earnings getting smashed. You're seeing Kathy Wood's ARK fund making new lows this year already to start. And then you're seeing people fishing in complete value stocks like 10 PEs under that. So I think you're going to continue to see that. I think it's going to become much more directional for the market in general, but you're going to see an outperformance of these themes for a while, I think, for the entire first quarter.
All right, Lance, give me your first quarter views and tell me what if you feel like Jeff or where you're different, and want to get your perspective too.
Yeah, so towards the back end of December, I was trading but being very selective. Everyone called for that Santa Claus rally, and then we finally got it about the last week of the year. So far in 2022, it seems, and I think a lot of people are experiencing this while trading the markets, is you'll have a stock that looks fantastic, like let's say a NVIDIA or AMD one day, and maybe the next day it has a day two, some continuation, and then it's just boom, stuck in the mud for the next 2 or 3 trading sessions.
Right.
And I feel like, as a trader who's trading every day, swing trading, short-term trading, that can be, very, very confusing, but also, you think you're right. And maybe you were right for a day or two. And then you're kind of just left guessing, like, should I hold on to this? Should I take a stop? Should I, maybe roll my position or turn it into like a call spread out there? That's what I've seen. And it could be, lack of volume right now. And it seems like what Jeff was saying, to start the year, we've had a really solid rotation into value. If you look at companies like, let's say, like Ford, GM, IBM today, Intel with an upgrade up about 5+%. There's that rotation, but is that here to stay? I don't know. You could have next week a rotation into growth stocks again, and then it's everyone chasing. I think from a day-to-day, from a trader who's, following the markets every day and trying to make some profits, it's very difficult. And then you have also too people from last year who have these growth stocks, the DraftKings, the Penn, the Pelotons, the DocuSign, the Teladoc, the Squares, the Rokus, who these stocks are down 40, 50, 60%. And, most of these Cathie Wood stocks. And you have a large amount of people who are wondering, are they ever going to come back? That's
right.
a hard question to answer.
Very hard question to answer, and which is one of the reasons why the Russell has been so depressed for most of the year. Mm-hmm. Well, let me shed some light and give you guys my 5 cents on all of this. One of the things that I'm looking at, as you guys know, I look at momentum levels, and one of the things that I'm starting to see really strengthen is the number of stocks that are trading above $2. All stocks in the universe trading above $2. Doesn't matter what kind of stock. As long as they're trading above $2, they're in this calculation. And before the end of the year, the number of stocks trading above the 50-day moving average, all stocks, was like at 35%-ish. We just finally moved above 50th percentile yesterday, and we filled a big down gap. And also, if you look at that chart, you know what? Why don't I show this? Do you guys mind if I show you this while we're talking? Picture's worth 1,000 words.
Oh yeah.
Let me just share the screen real quick. So let me just show this to everybody. It'll make a lot more sense if I show it. So we go down here. Yeah, we're at 51.67% actually right now. And I've been watching this really, really closely over the last, say, month and a half since we bottomed out on momentum levels. And just give it a second. It's loading slowly because we're all on the Skype, but it'll come. Oh, wait a minute. Well, this is Russell stock. Sorry, I got the wrong one. I want to show you guys all stocks over $2, not just Russell stocks. So let me just do that real quick here. One second here. Sorry, guys, it's taking so long. Here we go. And again, this is all stocks that are trading above $2 per share. And you'll see right now how it looks like we bottomed out. And it looks like it's going higher. It'll load any second now. It's coming. Sorry, guys. But one of the things, I'll just kind of talk as we're waiting for this thing to load. But one of the things that I'm really excited about this is that, here, let me just put it on a 1 year. There we go. So you could see right now how this thing got filled here. And even if we look at it in a shorter time, it looks like the momentum levels. This is what I was concerned about, this gap here. And it looks like we filled this gap and it looks like we're going higher. And if you look at the Russell 2000, it has a very, very similar chart pattern. It looks almost identical to it. And that's one of the things that's telling me that we may go a little bit higher. So that's one of the major things that I've been actually paying attention to beginning of this year. There we go. So you could see that it's a very, very similar chart. I wish I could just put the two next to each other, but they do look very, very similar to each other. But that's what I wanted to share with you guys and show you that. So I think actually momentum levels are starting to come up a little bit, and they're starting to get a little bit better overall. Also, volatility levels are lower, and with interest rates higher, I think we may see the type of trend in consumer stocks stay. I think the biggest factor driving tech, in my opinion, and I want to hear what you guys have to think about this, is I think most investors are looking to see if the Fed is going to back away from their timeline a little bit. If they back away from their timeline, because this interest rate increase, this yield increase, it's putting a big wet blanket on the tech sector. So I believe if the Fed backs away a little bit, if they find that the COVID is running a little too hot, or they back away, which they tend to do, or if earnings outperform or begin outperforming on the tech, we'll have another major leg up. I think that is the biggest factor that investors are waiting to see. So, Jeff, what do you think about that?
I think we've been living in fantasy land, frankly, and a lot of assets, and like, magical pixie dust on everything, and praying for, when you can't get an interest rate on your money, you get creative with the kind of shit you do with your money. I know I have. Sometimes I'm like, wait a second, the hell was that crypto I bought? I barely know anything about it. Some dude was telling me about it for like half an hour. I was like, yeah, that's worth $5,000. But, that's magical pixie dust thinking, right? That's not investing in real assets, in real stuff. So you're seeing this rotation into reality. The problem is we're sitting in this economy right now that's so busted, so non-functioning. Have you been to a Publix lately, to a supermarket, which is normally like one of the top rated supermarkets in the United States? They don't even have oranges in the state of Florida in a freaking supermarket. All we have are oranges in Florida, and they can't get into the supermarket to sell them to people. The economy's busted. So you've got a Fed that's sitting here between a rock and a hard place, and they're going like, what are we going to do? We can't crash the market, which it will if we start raising rates too quickly, but we can't let this inflation get any more out of pocket, because it's actually hurting like crazy the real economy. And there's a lot of political pressure from that. So Fed's going to be forced to act. It's going to hurt, and then they're going to have to back away. But I don't see a situation where there's a soft landing where inflation just naturally comes down, everyone gets happy again, and all of a sudden you find everything in the markets like you want, and the stock market doesn't have some sort of like violent gyrations in the meantime. I don't see a situation this quarter where that doesn't happen, honestly. And as long as like these stocks, these massive, the only thing that's keeping the NASDAQ from completely imploding are the mega cap tech stocks like Apple and Microsoft, which are also priced at the extreme level of their valuation range over the last 10 years. So if you get some profit taking in those things, I think you could get a pain train in the stock market. I think the Russell will still outperform and probably not be down that much, but I think it'll be an opportunity to price into a lot of things. I'm looking for a bottoming out in those stocks before I get constructively bullish on the stock market.
Gotcha. What about you, Lance? Are you expecting a big tidal wave before we get bullish again, or do you think we're going to just kind of peter out around here, recalibrate index the various sectors, and go higher from these levels? What's your 5 cents?
I think the most pain would be NASDAQ sells off a little bit more, as we saw yesterday. I mean, that was a nice sell-off in the Qs. You had some internet software names down 8-9%. I think we have NASDAQ stocks maybe for a week or two, maybe a little bit more volatility. We get a dead cat bounce. People get bullish again on growth stocks. And then we have a flush. That, in my opinion, would be the most pain out there, where people think, okay, I'm finally going to buy the dip in tech. Really like these, Squares, PayPals, Roku's that have been beaten down. They get a little bit of a bounce, and then boom, game over. They flush down lower, causes max pain. The people who, the little bit of ammo they had left that they put in the market from being hurt in 2021 on these stocks, that's it. And then from there, I think we could have some really nice upside.
I think you may be right. I think we're not done quite yet. I think we're going to still show some hope on I'm with you. My analysis is just a little, and again, you guys are not really that off of each other. You're pretty much saying very similar stuff. Your timing is just a little bit away from each other, which is fine. I mean, that's how none of us have a crystal ball. But
timing's the hardest part, right?
Of course.
Right.
Well, that's what makes this discussion so interesting. Right. We all have different, we're kind of all saying the same thing, but our timeline is a little shifty.
I have a question for you guys. Let me frame it differently. Let's think about this differently for just a second. And I'll ask Roger this first. Do you see a situation where we can have tech be weak and continuing to downtrend, and the overall market continuing to make new highs every day? Because I don't. I think at some point it becomes a total drag at some point.
Completely. There's too much tech. There's too much tech everywhere. No, I don't think that scenario is possible at all.
It's going to always be kind of like an overhang. It's kind of like a storm that needs to happen so that the sun can come back out. And I think it's like, as long as that's hanging over the market where people are feeling bad in a lot of these stocks, I think that's going to be an overhang. I think it has to flush. And these 2%, and to Lance's point, we have had some decent selling. in a lot of names and in the NASDAQ, but we haven't had any capitulation. It's been calm. It's been orderly. And it hasn't bled to the rest of the market. I think I've lived through a few cycles of these things. In 99, NASDAQ was the whole game. NASDAQ went from 1,000 to 5,000. S&P didn't do so much. But when the NASDAQ collapsed and did a round trip, I love that word, round trip, it bled to everywhere. Financial stocks got smashed. Oil got smashed. Everything got smashed in that fallout. I'm not saying we head to like total crash situation, but I don't see a scenario where we get like this march of new highs while we have all these stocks still in a bad way.
Yeah, I agree. I just simply think that we're going to hang out. I think that the market, I think the institutional investors are going to try to do everything possible to make the tech stocks look good before taking them down. Kind of all I'm saying is, I think before we have the capitulation, I think we're going to see another leg, possibly just another sucker rally, giving investors from last year a little more hope to get in.
And that hope may happen, in my opinion, in February, mid to late February, when you start having those pre-earning runs, and some of those NASDAQ names, like Netflix to start off earnings season. That might be this is the bottom. It's time to, how traders and investors get around earnings. They're like, all right, well, Netflix always outperforms on earnings, or Apple always outperforms. It's their shining light. I think that's a big question to be seen.
Well, and I think that's the $1 million question. I think if the earning estimates, because last quarter we had the same scenario and the estimates just kept getting better and better and better. Yeah. That carrot kept getting fatter and fatter and fatter and fatter, and tech didn't come down at all. But I think this quarter they actually will. I think they will come in. I think it will impact them. The question is how much. But I think this is going to be one of those. Remember, this is the first quarter, or getting close to the first quarter, where some of these companies are standing on their own 2 feet. So they can't really use the COVID, 2 years ago. They can't really use that as a big excuse anymore. So I think that's going to come into play substantially over the next few months. I'm just curious to see if the chips are going to rescue the rest of the NASDAQ, because that's what they've been doing. If you look at most NASDAQ, it isn't doing as well as chips. Chips have been really pumping it up because of the supply chain. I think the supply chain is mostly priced in. So I do believe we're going to have some last minute, surprises. But I think for the most part, we do need to have that capitulation. I just think it's going to come a little bit later, probably around February. I think January, I think institutions going to want to make the market appear a little stronger than it is still. We're going to have that fight between the Dow and the S&P and the SOX index. Again, these are all just my opinions. And also, I think bonds, if you look at the bonds went south like crazy, but it didn't really impact the stock market, which is telling me last few days, as you guys know, that we dropped 4 handles, and it didn't really have much of an impact on the stock market. So I think that we're still seeing some degree of recalibration taking place. And I think we'll see where I think we'll have a better idea of where things will be about a week from now, because right now, I think just now, the institutional investors, the liquidity is starting to come back, the volume, the directional pressure starting to come. So I think between now and maybe the end of next week, we'll have a better idea of where we stand. What about individual sectors? Jeff, let's start with Lance this time. Lance, if you had 3 sectors that you were super bullish and 3 sectors you were super bearish on, what would they be?
So January 1st, I said to myself, travel names caught a bid. And as we all have seen, COVID cases are, through the roof and everything, not to get on that discussion. But I will say the travel names, this is so Monday, day 1, Tuesday, day 2, despite the big sell-off in the Qs. Today, day 3, they're holding up well again. I'm actually, and last year I could have said this a million times and I never took action to it, thankfully. I actually really like travel stocks. TripAdvisor, where you go, you book your trip, plane, hotel. For the first time in, I would say, probably 6 to 8 months, finally saw some decent call buying going out till March, which, I know March doesn't seem that long away, but I mean, everything else we've been getting all last year has been weekly options or, front month options. I really like seeing this stuff. So names like TripAdvisor, names like Expedia, your strong airliners like Alaskan Airlines, your United Airlines, your Delta, and even the casinos. One particular that's been beat down, like Las Vegas Sands, and Wynn. I know MGM's been doing well, but I feel like from a risk versus reward point of view, these, if they start to bounce back, they're not at all-time highs. A lot of them have been, kind of stuck in the mud, trading sideways or lower lately. You actually have some resistance, some upsides. If you're trading technicals, you could trade off that. But I actually like the travel names. And I don't know if they're going to turn around like in a month or two, but I'm saying, 6 to 8 months out or so, I think they're higher from where they're trading right now. So if I had to pick one sector to be bullish on, it would be travel stocks. Number two, and I know they're starting to move higher, that I have been liking for a while now, is food and beverage names. Coca-Cola's been getting upgrades, Pepsi. I like names like Kraft Times, ConAgra Foods. I've just been very bullish. Their boring stocks are very low beta.
That's okay.
Right. But if you're trading options, you can buy 1-2 month out options for very, very cheap in these names. That's why I like
have
trading.
a high implied volatility. Yeah.
Right. Exactly. Like, you catch a 1.5% move in Coca-Cola or Kraft Times, those options are going to move compared to catching a 1% move in Tesla or Nvidia, where those options were, might not even be green on the day. So I really like that.
Yeah.
Food and beverage. And then if I had to pick a bearish sector,
yeah.
And, I hate to be the bear in the group.
I don't think you're going to out-bear me today, kid. Nice try, though.
Yeah. I just feel like, they're going to come and get me if I'm bearish on something. I'm actually slightly bearish on retail. Some of the retail names, again, very volatile. I will say.
You've been watching my videos, Lance. You've been watching my videos. I'm long MGM. I'm long MGM, and I'm short Ross. So I'm just saying. Oh, but anyways, go ahead, please continue.
I just got short Kohl's. So same, discount retailer stuff. Very similar. It's just the retail names like TJ Maxx, Macy's, Kohl's, even Dick's. Some of these had a huge run up lately. Like if you look at Macy's, for example, or even Kohl's back in November, I just think they got a little bit ahead of themselves. And I still think you're going to have issues with supply chain. And you had the holidays pass. You had, your Black Fridays. You had your Christmas shopping. I just don't have a very bullish outlook for retail. And I love trading these names. Under Armour is probably my most actively traded stock of 2021, but I'm just not feeling retail here.
The only retail I like is Crocs and Lululemon, just for the record. Jeff, tell me your favorite couple of sectors and real specific sectors, and two sectors or one or two sectors that you really don't like.
Okay. So to go off the same case I've been on, I think you got to be long. I think you still have to be long here, financials. And I think regional financials are particularly attractive because they've been lagging the mega caps. And when you have a steepening of the yield curve like we're seeing, and I think it's going to get much steeper because of that flight to safety, I think there's going to be a lot of money. I think there's going to be a lot of money that those guys make. They're going to crush their quarters. So that's an obvious trade to me. I think there's going to be a shock move in rates higher. I think that energy is going to go a lot higher. I see oil trading well above $100 a barrel this year, much to the chagrin of a lot of people. But the drillers are also lagging. They're lagging the underlying crude. So that's another low-hanging fruit. What would I avoid? That's a very important question. I would avoid software stocks right now. A lot of these stocks are getting pummeled, and people are like, are they cheap enough? And I'm like, they're still like, up 200% from 2020 lows. So yeah, no, they're not cheap enough. They get much cheaper, specifically the ones that are trading at 400, 500 PE. So look at your portfolios, figure out first, here's the first thing I think investors don't do enough of. They don't do enough of looking at what the total value of a company. Like, let's do some fundamental analysis. We talk a lot about technicals and macro, but one thing a lot of people don't do is fundamental analysis. Is like they don't look at the total value of the business, what the market value's at, and what these guys are actually doing in the real world. So, for example, a really interesting story right now is Viacom. That's another sector I like. I like these media plays that are not playing at the trading at the multiple of a Netflix. Right. Viacom has Paramount Plus, which made $5 billion. If they were getting the same valuation on just that one component of their business, they have other businesses that they own that are very nice. It would be worth $50 billion, just that one business. Viacom's entire stock PE, I haven't looked at this morning, but was in the 20s, low 20s as of yesterday. So that's why people are buying these Viacoms, they're buying these Discoveries. I think that has a lot of room to go. But if you're long like super high PE stocks, I think you're going to be in deep shit because I think rates are going to go much, much higher. I don't think they're going to be able to control it super quickly. I don't think they're going to be able to.
Nobody wants to talk T, Viacom, Verizon, Discovery.
They're great businesses. Those are great businesses.
They're not sexy.
They're going to keep the market from fully crashing. Those stocks.
They're not sexy. So you'll never hear anyone in the media talk about these stocks.
Right.
They'll talk about your Netflix, your Disney's,
right.
Which you're going to get gray hair and wrinkles trading or investing in, having to pick, tops and bottoms. But I have been trading AT&T. Talk about cheap options.
People are looking for value in big name companies in sectors that are like Intel is another example.
Intel.
We had FT Trader put it on our chat. They said you're seeing a rotation into Intel and Micron out of AMD, Nvidia, and TSM. Guess what? I've been playing for like the last 2 years a money link long AMD and short Intel. I'm not excited to do that trade right now. AMD has run like crazy and is getting smashed past couple of days. But if Intel gets their thing going, that stock could rip to the upside. So those are the cases where I think they're going to keep the market from full smash bros, which I think is a possibility because of rates. The shock rates move, I expect. And
also, if you're trading too, you're going to be able to have cheap options in stocks like T, Verizon, Discovery, Viacom.
Travelers.
The cheap options, if you're an investor and you like to buy and hold these names, you're getting dividends. Compared to trading like an AMD or Nvidia, where you go buy a weekly option, you're going to spend $500-700 just for one contract, right?
And you'll be 30 points out of the money.
Exactly. And then you have to be right, and you need to be right instantly, or else the option goes against you. And from a risk versus reward point of view, not only from buying expensive options, usually they don't move from a percentage point of view of cheaper options. But that's difficult, especially if you have a small account to do. So I'm with you, Jeff. I've been avoiding, your AMDs, your NVIDIAs, and I get everyone, they're sexy. You hear about them all over TV and stuff like that. But I mean, they're big boy trades, and I don't want that risk right now.
So this guy, I read a really good article the other day, another one of our type of colleagues in financial research, and he calls them the Ponzi. I'm not going to mention his name because I don't know, he didn't get it right, but he calls them the Ponzi sector stocks, which is basically like greater fool theory versus real assets. And that's the play that you're seeing now. It's not just value. It's like, what does the business do? And what are their, what are their ways of making money? And do they make money? So the first thing you have to ask yourself is, does this company make money? And is it justified that they trade at this multiple? Because if not, it can go so much lower. Like, the famous last words, it can't get much worse. It can get so much worse in those air pocket stocks. And companies that are trading at companies that are trading with a $30 billion market cap that make $30 million have a tremendous amount of downside. Guess what? That's
very
reality.
Much so.
So you have to
we saw that in EVs last year, and even this year. You look at Rivian, it's going to happen. You look at Lucid Motors, you look at Arcimoto, you look at Solo, you look at Workhorse, you look at all these EV companies with all this hype and smoke and mirrors that never had any vehicles, never sold any vehicles, never produced any vehicles, never had any money coming in, and just spent hundreds of millions.
Yeah.
And the valuation is like Ford.
Yeah, or more than Ford. And now you're seeing, okay, those people
Ford makes EV cars too, the best trucks. That's why they're bid. So does General Motors.
And now you see Ford reacting while the other stocks, which, sadly, they probably won't even be companies in a year or two from now.
Right. Or they'll be, I think a lot of these companies will actually be in business, but they'll be making parts, batteries, things like that for other companies like GM and Ford, which is kind of in history. That's how it's happened with car manufacturers and companies before. Folks, this is great. I love it. Look at this. We haven't mentioned any Ferraris. We haven't mentioned any mansions. We haven't mentioned $1 million trades. We've been just talking about meat and potatoes. And here's what I want to tell you all, for all of you folks listening at home. 2022 is going to be that kind of year at Wealth Press. This is going to be a no fluff year. You know how the markets are moving away from all the tech and all the fluffs? We're doing the same thing. We're going into value. We're going into giving you guys a lot of value, just like we did in the last half hour. Now, if you guys enjoyed this, and I hope you guys do, I want you guys to pay attention to what I'm about to tell you. Now, I had a class a few days ago called Turning Point 2022. It was all value. In about an hour and 25 minutes, one of the guys on this broadcast, Jeff Zananeri, the guy that's right there, he's going to do the same thing. Folks, this is going to be all Judith, Sharky. If you guys are liking this, this is going to be an hour of Jeff, and I'll do about 10 minutes, but let me just tell you what Jeff is going to talk about. This is going to be some good stuff. He's going to talk about institutional accumulation, how it smashed S&P returns, a specific strategy designed to pick up on a handful of stocks at the beginning of the month that are likely to outperform, how he looks at institutional accumulation, what the big money's doing, enters several positions at once, how he holds them for the next month. Very simple and effective. So far, this has delivered 14.8% every 26 days on live trades. I'm very impressed with this. So make sure, we're going to post a link in the chat. Actually, I see a link in the chat already. Gus says he can't wait. I can't wait either.
We've discussed a lot of the So, today's a great day. I can't wait. I'm going to really dive deep in and be granular about the methodology behind it. But what we just discussed was corroborated by my filter system, by my scanner that picks these trades. It does most of the work for me. And then the art aspect of trading is me, process of elimination. Well, I can't be in this stock. I can't be in this stock because of this, because of this, because of this. But then I come out with this list. Lo and behold, I'm going to talk about it today, but the list came out this morning and is going to be perfectly tradable for a while, for at least the next few days. We've talked about a lot of these sectors. So we have a lot of interesting names in there. I give you a stock and I give you an option, but I'm going to talk in detail about it at 1:00. And I hope you guys join me because it's going to be really fun. It's going to be a lot more dorky than our typical presentation, which we've all been kind of like.
Dorky's good. Dorky means technical, more meat and potatoes.
Yeah, wonky, more just for traders. What I really loved about this show is this vibe that we got going on the first one, and I think it's going to get better and better, is we really just showed you how hardcore we're into the markets. And we got a lot of great questions here too. I can tell the people that are on this are also hardcore market junkies too. So 2022 is going to be the year of the hardcore market junkie at Wealth Press. We're going to
and we want you guys to watch, participate. Do not forget. Noah's going to post that link again right now. Please do not miss this. This is going to be no shiny lights, objects, no talking about how we live our lives. This is going to be about how we can help you make money in the markets. That's what this is going to be about. BB says, great session, guys. Can't wait for Jeff's session.
Oh, BB.
Somebody here is really glad that Lance is here. I'm looking forward to doing this more with Lance. Lance will be a big part of this in 2022 as well. So this has been a great session. We're going to do these every week. And if you guys can't make it on, we're going to post them. I don't know where we're going to post them, but we'll make them available for you guys. And we will be doing this every week for 2022. So get excited.
Yes. Also, too, Roger, if they go, that link in the chat will take them directly to that Zoom link too. So just know that link in the chat takes you directly to Jeff. So pretty cool.
So this is the link. Get it, write it down, remember it. It's all happening. FT Trader, we love being here. And Jeff, I will catch you in about an hour and 10 minutes on the other side. Yeah. Lance, Thank you for your time. I really value you very much, Lance. And this is a great, it's always good to have the three of us here because it's good to get the contradictory views and get kind of see what everybody's thinking and all be on the same page. So people here really love seeing you, Jeff, Lance. Thank you, everyone. If you guys have and if you guys have feedback, if you guys want to tell us something about this, send us an email. We're going to post our emails here. Here's my email. And Jeff and Lance, please feel free to post
yours. This is going to be such a year of don't try this at home, kids. I mean by that, it's going to be a pros year. So we're going to be here the whole time with these brainstorming sessions, these spitballing, trader shop talk sessions. And it's good. You're going to need it. We're going to need it.
I think that's the main thing is it's not going to be easy. And I hate to give spoilers out, but I don't think it's going to be buy something with your eyes closed, hope and dream for the next 2 weeks it goes up. We're 3 days into the 3 trading sessions in, and I'm already like, wow, this is some nasty shakeouts. Like I said this all morning, like I can't believe how nasty the way this market is trading.
There's violence. There's violence on the upside too.
Yeah.
People are
and
panicking.
Jeff messaged me yesterday afternoon saying the same thing. He's like, can you believe this market? And I'm like, dude, it is nasty. So we're going to be here. We see so many familiar people in the chat. Glenn, Mary, Carol. I know I'm BB forgetting to I was just scrolling through the chat now. I wish I could message each and every one of you. Great to see you guys and girls here. But yeah, look forward to the next one. We'll plan it. We'll send you an email. So check your emails and can't wait to be back.
Bye, everyone. We'll see you all in about an hour and 10 minutes in Jeff's session. Don't miss out. It's going to be all meat and potatoes. Link is posted. Bye, everyone. Thanks, Lance. Thanks, Jeff. Bye, guys.
Thank you, gentlemen.
Thank you.